Imagine this scenario. You're sitting in your office in New York, London, or Dubai. You get a call or maybe a legal letter confirming that you have inherited your family's ancestral home in Mumbai, a bungalow in Bangalore, or perhaps prime land in Punjab. On paper, you've just added millions to your net worth. It's a moment of pride, a connection to your roots, and, let's be honest, a significant financial event. But here is the hard truth that most high net worth individuals ignore until it's too late. Inheriting property in India is tax-free, but holding it and eventually selling it, that is where wealth evaporates. I'm Kunal from EPK Capital, where we build wealth for generations. Today, I'm going to reveal the number one mistake NRIs make with inherited property. A mistake that turns a high-value asset into a liquidity trap. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs. You can download it by clicking the link in the description. Let's get started now. So, what is this mistake? Is it failing to pay property tax? Is it forgetting to maintain the house? No. The number one mistake is passive inheritance. It's the failure to treat that inherited house as a financial asset immediately. Most HNIs treat inherited property as a family souvenir. You keep it because you're busy, or because of emotional attachment, or simply because dealing with Indian bureaucracy feels overwhelming from thousands of miles away. But are you? If your property appreciates by 5% a year, but the rupee depreciates against the dollar by 3 to 4%, your real return might be negative. Passive inheritance leads to 3 major wealth destroyers: legal limbo, the TDS shock, the repatriation wall. Let's break these down, because at EPK Capital, we believe clarity is the first step to compounding. Let's start with the basics. The will is just a piece of paper until it is probated and the title is updated in the records. This process is called mutation. Here is the common scenario. An NRI client decides to sell a property for 10 crores. The price is agreed. The buyer's lawyer finds the property is still in the grandfather's name. The deal collapses immediately. If you have inherited property, do not wait for a sale to fix the paperwork. Mutate the title today. Make the asset liquid. Now, let's talk about the money. This is where the landscape has shifted dramatically as of July 2024. The Indian government reduced the LTCG rate to 12.5% without indexation. But for older properties, you have a choice: 12.5% or 20% with indexation. Run the math. This decision alone can swing your net profit by 10 to 15%. Don't let a generic accountant decide this for you. This brings me to the silent killer of liquidity, TDS. For an NRI, the rules are aggressive. The buyer is legally required to deduct TDS at the highest rate, usually 20% plus surcharge, on the total sale value. If you sell for $1 million, the buyer might withhold $230,000 upfront. That money is locked up for months. A massive opportunity cost. The solution? Apply for a lower deduction certificate, Form 13, before the sale. It instructs the officer to match your actual tax. And finally, getting the money out. You can repatriate up to $1 million per financial year. $3 million takes years to move. So, let's summarize. Here is your 3-step wealth protection plan: legal audit, valuation versus yield, and exit engineering. At EPK Capital, we don't just look at stocks. We look at your total balance sheet, including that bungalow you haven't visited in years. Wealth is about what you can access and grow. If you want to restructure your assets, let's have a conversation. I'm Kunal from EPK Capital.